if you're like most Americans, you probably don't have the cash down readily available to buy most of life's more expensive kind of luxuries. Things like cars or houses kind of fall into that category. And that's understandable, though that is why they have what is called a credit score. You know, that 300 to 850 range that really kind of decides whether or not you can actually get a lot of those financial dream goals a lot earlier than you would be otherwise. My name is Michael, and this is the Credit Academy, and on today's episode, we're going to be talking in a little bit more depth about specifically the credit score and how it works across the different scoring models. So, kind of jumping on into things, let's start at the very basics here with just what exactly is a credit score. Well, once again, credit scores are going to be a 3-digit number that at a glance kind of tell the lenders, you know, your credit worthiness and overall just your credit history with managing your own loans, you know, paying them back on time, things like that. And honestly, the lower your score is, the more risky you look to the lenders. So generally, you want to keep your score as high as possible. Now, I did kind of talk about that range. It is a 300 to 850. So 300 being the absolute lowest you can go and 850 being the highest, which you always want to go for that 850 credit score. Another aspect of having a lower end credit score is going to come from things like interest rates. Now, we'll dive a little bit deeper into that, but generally the thing to keep in mind with interest rates is especially revolving lines of credit, interest will accrue on those amounts monthly that you keep on file as a balance. So you're going to be actually adding more on to the owed amount if you have a higher interest rate. So that's why, you know, especially for a lot of those, you know, very long loans like fixed year mortgages, things like that, you want to go with as low of an interest rate as possible because you are actually kind of interacting and having to pay off this mortgage and interacting once again with those interest rates for up to 30 years sometimes. So, and that can be a lot of money. And kind of in the vice versa territory, you know, having a higher end credit score, you know, pushing 700 and up, you're going to see a lot more favorable terms towards, you know, a lot of the offers you'll get, as well as things like the interest rates. You're going to get a lot lower interest rates, and overall, you're going to be saving a lot more money. Also, some things are going to be specifically locked behind having a good credit score. Certain credit cards, as well as credit card benefits, won't even be available to you until you start pushing upwards of that 740 mark. What a lot of people don't realize when it comes to credit scores is there is going to be more than one singular scoring model. So what are those scoring models then? Well, you're going to have the FICO scoring model as well as the Vantage scoring model. And generally the differences between them boil down to how the categories on your credit report are weighted when calculating your overall credit score. So in general, though, they are still going to use that 300 to 850, but you can generally also see, you know, pretty significant score differences. And oftentimes, a lot of people will see a Vantage score that is a 50-point difference from a FICO score. So it's definitely worth kind of keeping up to date on both if you're able to. So one thing to note about Vantage that I want to talk about is that it wasn't always actually a 300 to 850 scoring ratio. Now, Vantage Score is a scoring model created by the 3 major credit bureaus, which is Equifax, Experian, and TransUnion, and the score was managed and maintained by an independent company called Vantage Scoring Solutions, LLC. Now, the earlier Vantage scoring models like Vantage 1.0 and 2.0 were on a scale range of 501 to 990, which is a drastically different kind of scoring model from the traditional 300 to 850 we've been talking about. Now, they also assigned letter grades kind of to their scores they were giving out, kind of almost like a financial report card, if you could think of it that way. Now, for example, some of these ranges were, say, a 900 to 990 was going to be that, you know, A+ report. An 800 to 899 was going to equal a B, and then a 700 to 799 C, 600 to 699 D, and then 501 to 599 being an F. So in 2013, Vantage Score 3.0 came out, which is when they decided to kind of equalize it more on terms with the more popular kind of scoring model, that FICO scoring model. So, and that was going to be, once again, that 300 to 850 range. And to this day, Vantage 3.0 is going to be the most widely used Vantage scoring model. So we've been talking a lot about kind of Vantage scoring models. Well, where can you actually find that scoring then? Well, you can get your Vantage scoring model through websites like Credit Karma, which utilizes the Vantage 3.0 scoring model. Quizzle, another website, once again, uses that 3.0, as well as Credit Sesame. So all three of these websites are great tools for you to go to and actually stay up to date on your Vantage scoring models. Now, you can also discover your FICO scores for free if you want to also pay attention to your FICO scores with certain credit cards. Like Discover offers FICO 8 through TransUnion, as well as Bank of America, which also offers FICO 8 through TransUnion, and then Wells Fargo, which offers FICO 9 through Experian. So there's going to be some options for you, especially if you already have a credit card, for you to be able to check your credit score for free. If none of these are an option for you, you can also check your FICO 8, 9, auto, and mortgage scores through www.myfico.com. Now, this is going to cost some money. It's going to range between $19.99 to $39.99 per month, but I heavily recommend it, especially if you're, considering kind of looking at your credit score frequently if you're building credit. It's a great tool to have, as well as FICO scores are going to be the scoring models that are used by the majority of lenders these days. So now that we've kind of cleared up the differences between both FICO and Vantage, let's talk a little bit more about some of the negative factors that can happen to your credit scores. Now, paying a credit card or loan 30 days late or more will heavily impact your credit score. Even just one of these missed payments can be detrimental to your score. So you really want to make sure, above all else, you are prioritizing on-time payments. Now, another thing that can hurt your score is having an account get sent to a collection agency. Basically, at any point you have a collection listed on your credit report, that will impact your score negatively. So it's very important to also try to avoid any collection accounts if possible. Now, also having a credit card balance reach the credit card limit is another thing. Now, we've talked a lot about this kind of in our Credit Agent Show series, but I do want to stress it here, especially kind of in our more beginner-friendly course, where the utilization rate is very important when it comes to you and your credit lines. Now, what I mean by utilization rate is essentially, if you get a credit card, you get what's called a credit limit. Now, that limit can be anywhere between, say $100 up to, upwards of $40,000 or even more than that. So essentially, that limit itself is going to be the max amount of money you're going to be able to charge to the card monthly, or, revolving in any case. So it's very important that you don't ever go up to that limit. And honestly, if you can, stay below or well below 30% of that total overall limit, because a lot of people also think it's only once you start reaching that upper end that you start to get some negative hits on your credit score, but it starts as early as 30%. So if you're able to keep it even below 10%, just make sure you're using the cards though, because if you don't use your card to at least 1%, they will automatically close them. But if you kind of keep it between that 1 and honestly 7% if you can really maximize the score benefit from having a credit card. Another thing I want to talk about is going to be hard inquiry checks. So I've given some, ways for you to personally check your credit score. Now, it is a common misconception that checking your own credit score can actually lower it. This just isn't true. And we did cover this in our common misconceptions on episode 1, but I do want to kind of clear this up once again, because it is very important to note in your head that you can check your credit score and monitor your own credit as much as you like. It's only when you apply for brand new lines of credit and when those lenders check your credit score or credit report that a hard inquiry is put on your kind of credit report, and too many of those could actually lower your credit score. So we generally recommend anywhere from 3 to 6 months of waiting between applying for, say another credit card or another loan, student loans, things like that. That'll really kind of allow enough time for those hard inquiry checks from the previous application to fall off, even if you get accepted, and then you can begin once again applying for new lines of credit. Now, I do want to switch gears over to some of the more positive factors that can go into your credit score. So, once again, paying all of your credit cards and loans on time are very important, and honestly a requirement when it comes to kind of going for a lot of those more perfect credit scores, aka 800+. Now, also having zero collection accounts falls into that category. You really want to try and have zero collection accounts if you can forever. And then also keeping credit card balances between $1 1 and 30%. Now, like what I said previously with the credit utilization rate, if you can honestly keep it between 1 and 7%, you'll give yourself a big enough buffer between that 7 to 30. And honestly, it gives you a little bit of playroom when it comes to you and your credit without having to worry about so much about, becoming higher risk in that way. Also, diversifying your credit portfolio, which is something I haven't talked about yet, but credit mix is an aspect that is factored into your credit score. So what do I mean by credit mix? Well, essentially, this means you have a healthy amount of credit lines and diverse amount of credit lines. And generally what we recommend is anywhere from 3 to 5 credit cards. And then also in there, maybe you have a auto loan or a mortgage loan, student loans, anything like that. And overall, it just shows to the lenders themselves that you're able to manage all of these, accounts and debt effectively, as well as if you're paying them all on time, you can actually raise your credit score a lot faster than you would if you only said have maybe 1 or 2 credit cards. Another thing I want to talk about is, once again, going back to hard inquiries. You can really maximize the positive score benefit by making sure you wait 6 to 12 months. Now, I know I said 3 to 6 before, but honestly, 6 to 12 is where the majority of these hard inquiries are going to fall off. So if you can wait that long before you actually apply for a brand new line of credit, or if you're enrolled in some credit monitoring services, take a look at your credit report during this time span, and then you can figure out exactly when that hard inquiry check fell off, so then you can start applying again. So now let's talk about some things that will never affect your credit score. Well, your income will definitely never affect your credit score. It's not even factored at all. Your age won't either, as well as your gender or race. Your address or where you live also won't affect it, but it is to note you should only ever have one name and one address on your credit report, because some collection accounts will be tied to those previous names or addresses, which, we'll talk a little bit later on about that in a future episode when it comes to disputing. Also, your favorite sports team is not going to be factored into your credit score. So any of these things, if you're worried about them, kind of being listed anywhere on your credit report for some reason and affecting your score, you shouldn't be. It will never fall into line and affect your credit score directly. So once again, credit scores can be complicated. And, just like most of the other episodes we've talked about, it is really just about kind of organizing the information and digesting it in the right order, because there's a lot of sources online, but it can be very confusing and overwhelming at times. So I thank you guys definitely for tuning on into this episode of the Credit Academy, and definitely check out our other links. We have a podcast where you can learn more about credit and kind of more up-to-date topics. Also, be sure to follow our other socials such as Twitter, Instagram, as well as our TikTok, where we're always giving out more free credit advice. Also, we have a couple of Facebook groups as well as our Facebook page listed down below, and we have a free 15-minute consultation link that you can enroll in today. So we hope to see you guys in the next one. My name is Michael, and thanks so much for watching.